Hey, everybody, it's Pete Carmasino here at Chaikin Analytics. This is our halftime show here on StockCharts TV. Thanks for joining me. Each and every week, we kind of go over just some things that are happening here in the markets. We like to look at some sector reviews. Today, we'll look at the bond picture using TLT from over a year ago, back to December of 2021, where I penned an article warning bond holders that this is not going to be good for you, and that we had a target on TLT at around, 97 or so. I'll bring up the chart. We'll look at it, but there's a point to it. The point is that trends are developing and they're changing all the time. And when you have an outside catalyst that has been forecasted for months and months and months and months, and understandably, the reason of raising rates was to fight inflation. And when you see inflation rising month after month after month, you got to put two and two together and start to say, okay, how is this going to affect the asset classes that I own? And the potential other effect, which is the future cash flows of those assets like tech stocks and what happened there. Last week, we did a video, we talked about tech being the safe haven this past week or so, and it certainly has held up to that standard. Why? Well, rates are sort of subsiding. Today, you're seeing a different story. You're seeing bonds moving lower, and we know there's an inverse relationship to bonds and interest rates. As bond prices fall, rates rise. That puts pressure back on interest rate sensitive components like tech and things of that nature. So we are seeing push and pull, although one thing did develop this morning, and that's rally number 6 of this bear market, so to speak. And we're still calling it a bear. I'm calling it a bear market under the circumstances of just really we're sideways. I mean, if I look at where we are, we're at levels we haven't seen in a few years. And I'm just scrolling back here on a chart. I'm looking back to the S&P. I mean, this is, the S&P was here back in 2021, January. So that's almost 2 years of sort of sideways action. We had a big move up and a big move down. And here we are again back there. Now, we're just trying to follow sectors and try to, identify trends and things of that nature. On the Chaikin system today, we're just going to look at kind of what some people do anticipate that actually does move a potential stock in one direction or another, or I should say a stock in a potential direction of one way or the other, up or down. And that's either bullish or bearish estimate revisions. And so we actually have a screen for that because that's one of our factors. And I thought it would be interesting to see which names over the weekend have registered a bullish estimate change and which ones have registered a bearish one. I think you're going to be surprised at some of the names that you see here. So let's dive in and see what these charts are telling us today. All right. I measure these rallies as at least a 5% rally from the recent swing low. And I'm counting rally number 6, and that's coming from really the March of 2022. So it's interesting that about a year and 20 days later, from that March 7th bottom, we saw a top put in on the rally. Now, this just happened today, and I'm not saying that this is a top. What I'm saying is that this constitutes a rally the way that I measure, which is at least a 5% move from the recent swing low. All right. And what did it do? It ran right into the 55. Now, this is a weekly chart, folks. I just want to be, make sure you're aware of that. It's a weekly chart. And, the low here was about 3808, and the high put in today was about 4003. And we are off the highs, significantly so. Not negative, but getting there. It's interesting because we're just getting this push and pull, back and forth. What's going on here in the banking sector? We talked about, that over the last week, and how some of our charts are pointing to, avoiding those names for many months, if not almost a year or so more. And that's why we follow trends. And when we're looking here at the S&P, this is the big picture. So we're doing some top-down analysis. That's, one way you can do it. And you've got all these great tools on the ACP platform. And when you combine them with some of the Chaikin tools that are available to you, and some of the things that we go over here, I think you're getting a really interesting edge. And so looking at bullish percent, the S&P, this is the NYSE. This is the New York Composite up top. The middle is the NASDAQ Composite, and down here is the S&P 500. And the bullish percentage is measuring, over time. We're just seeing this moving lower as the market, the index itself moves lower, and just not getting that push that we'd like to see. NASDAQ being the most negative here so far to start the week. You can see that's got a red candle here, a red bar, so to speak, and the other two are gray. But at the end of the day, it is rally number 6, which is pretty unbelievable, considering what's happened in the last week. It's pretty amazing that the market is showing such resiliency. I think that's a learned behavior over time, and you know what? Hey, we'll take it. We're investors, so we're looking at this from a standpoint of practitioner and coach and vendor and certainly investor. So when you look at all of this, you see a nice rally here. It's holding up. It's not breaking the trend on the downside yet. We do have to be cognizant of that. That's around that 3,700 or so, 3,750. That would be that December low, and there's that October low. Nobody wants to see around 3,500, but let's just hope that things hold up there. I was going to talk about bonds, and I use TLT just because it's a name, or an ETF, I should say, that's obviously a 20-year plus Treasury ETF. And this shows you what happened to long duration bonds, right? And think about this, all right? Some of these banks had these on their balance sheet. The fact that the Fed told us, the fact that we saw M2, rally to incredible highs, spike basically after the stimulus and the lockdowns and things of that nature. The fact that we saw a pattern developing here on the TLT, and when I was able to start calling this out in December of 2021 at around that 145 level. And here's the facts. The fact is that on December 23rd, we penned this article. I started looking at that sort of a few days, if not a week before this went through editorial. But the Fed was telling bond investors to pound sand, right? And that was really the issue, right? I mean, you can read this, go back to Chaikin PowerFeed, look at the archives. You can see this. But you can see what happened with the yield. This is sort of the cognitive bias. You kind of learn behavior over time that, okay, rates just go down. It's going to be fine. But it wasn't, right? We talked about this, is that it's best to step aside from bonds while the Fed does its dirty work to tackle inflation. And, I can't say it any clearer. In the scenario that we laid out in this article, bond prices will almost certainly fall. And when bond prices fall, rates go up. And our target was 97. That's kind of in the middle of the box, around that 97 level right there. It surpassed that on the downside to around 90 and change. But it's really just been consolidating here, back and forth, back and forth. Are we out of the woods? I don't see that as being out of the woods, so to speak. You can take a closer look or put it up on your own charts and take a look and put your own indicators on there. Just doesn't look great. So, I think we still have to be cognizant. There's some things that are changing and there are things that are remaining the same. And inflation seems the one that is kind of just hanging around longer than anticipated. A lot of people look at this ratio. This is the growth over value ETF ratio. And so these are long-term trends, right? You can see where that's the 200 daily. You get the 50, and you certainly have, the 50 here in the red and the 100 in the green. And so the idea here is certainly like to see these crosses, see that 50 above there. That would be excellent. That was a good tell on the way down. But really what the tell was the RSI was already breaking down. This is a 6-month stochastic RSI. You can see that trend line was developed, broken, and then a second wave down. That was our level that we were looking at, that ratio about 1.8 or so. It's ironic that it's back there again and having trouble. I don't know what that means, but the point being is that's what charts are for. We just got to pay attention to the trend. As things set up, it could be consolidating here for a leg move higher. And then we might see the validation of those moving averages cross over. But, we know that nothing's guaranteed. So looking at another interesting ratio, this is the equal weight consumer discretionary over consumer staples. And it's interesting because you see discretionary taking the reins here right at the beginning of the year. It's tech weighted. We know that. There's Tesla and Amazon's in there. But the idea is that, when you see these ratios start to bottom, look at this bottoming process here, right? Sideways action, not breaking down. I mean, obviously it went to the lows back in June and then really didn't see anything worse than that in December. And that was really the ultimatum there that started to move higher. And that's predicated by what? The dollar rolled over. You had rates come down a little bit. Bonds started to rally and things started to firm up a little bit as far as sort of less volatility and more upside potential. So just be careful when that's taken away. We don't want to be caught short, so to speak, right? I'm going to pull this chart up one more time. Forgive me if I have to open up two different charts here. I don't know exactly. I have to label these better. Yep, this is the one. I had this up last week, and it's just interesting that the time I pulled it up since a week ago, right? This is a daily chart, and that was the 20th right here. We were below this level, rallied up, and now back down again to this box. This was the White House buy zone, right? It was $72. We were supposed to be looking at potential purchases. That's the high side. I gave it a standard deviation of like $3 to $5, and it's even sitting in this area, but I don't see a lot of purchases or pressure on the upside here. So again, it could be recessionary, but just be careful with this. I just wanted to point that out real quick. All right, folks, I wanted to go over the bullish estimate revisions, and there are two names here that are bullish in this list, and a couple of bearish names and some names in between. And I want to focus that in our system, and again, you can run this on the ACP platform. The reason I show our system, just so you understand, is that we're showing you some inside things that are going on our side that you can't see on the ACP platform. You're just getting the rating, and so I hope this helps you kind of straddle both systems a little bit and gives you some guidance about how we're looking at things. So when you can see in the public domain, you could see bullish estimate revisions and things of that nature. You can see that all the time. And you see Garmin here and you see KBH, you can look up, or any names that you see in the public domain, go look and see what our rating is on the ACP platform. So I say to you, focus on the bullish names, because you get some mixed signals on the other one. Like here's a name like Chewy. It's getting a relative strength breakdown. Right, it's breaking its long-term trend. You can see it's in a downtrend. And what are we talking about from a revision standpoint? We're talking about, not that big of a revision, right? You start to look at names like, Duke, and you start to look at VTEX, right? I mean, these are names that are like potentially losing less money, that kind of a name, right? So just be careful. I just wanted to point it out that you're looking at names that are sort of breaking down. If they're bearish for a reason, right? Fundamentally. And then obviously, technically, right, we don't want to be involved. The technicals typically tell us when, right? The fundamentals are telling us what. So you have to marry both of them together. That's why I say to you, focus on the bullish names that you can see on your ACP platform when you see estimate revisions out there in the public domain. Now, on the bearish side, sometimes the opposite happens, right? You start to see bearish estimate revisions on bullish names, right? But you got to be, cognizant of the trend. Here's Chaikin money flow, which you can draw on ACP. You start to see negative money flow there. You start to see RSI and our overbought oversold on lower levels. The relative strength breaking down as well. So even though it's a bullish name, getting this estimate revision, think about it. It's just losing less. It's losing more money, right? In other words, from a 69-cent loss, you're looking at a 73-cent loss, right? It's a bearish revision, but it's really not a good setup from an earnings standpoint at all. So to begin with, and you can see it's been in a negative trend that whole time. Here's a name that's another banking name, obviously out west, and you're looking at an estimate revision there, and it's coming off of some decent levels, again, from 73-cent earnings down to only 58. But the stock is sort of broken down. Obviously, it's gotten entangled into this mess of banks. But folks, I said this last week on one of the names we were looking at, which was Signature Bank. And here is PacWest. For the longest time, since this time last year, really in March or beginning of March, we had a negative relative strength breakdown, and it really didn't look back until it hit 23. Had a blip on the screen here, and then obviously got caught up in the rest of this thing. But here are the names that are negatively bearish estimate revisions. Just be careful when you see these names start to break down. Even though it's neutral plus, you got to look at the trend of the chart as well. All right, folks, that's all we have here for this week. Thanks again for tuning in. Again, I'm Pete Carmasino at Chaikin Analytics. You can follow me on Twitter at Pete Carmasino. We'll be here next week. Take care, everybody. Have a good one.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.